There is a number that the biggest banks in Canada do not want you to say out loud. That number is 70. As in 70 years. That is how long some Canadian homeowners are now mathematically scheduled to pay off their mortgages, not because they signed up for that, but because the banks quietly extended the clock when they could not afford to let those loans go bad. This is not a conspiracy theory. This is in the quarterly filings. This is in the regulator's own risk reports. And the people running this country's financial system are terrified of what happens next. We are sitting on top of a debt structure that was built during the lowest interest rates in recorded history. It was held together with the assumption that rates would stay near zero forever. They did not. And right now, as you watch this, nearly 2 million Canadian households are walking toward a renewal date that is going to hit them like a wall. The math is brutal. The income data is even worse. And the banks have been playing accounting games for the better part of 3 years to keep this thing from blowing up publicly. Let me show you exactly how deep this goes. Start with the basics. Canada's top 7 lenders, including RBC, TD, Scotiabank, BMO, CIBC, National Bank, and Desjardins, collectively hold about $1.6 trillion in residential mortgages. That figure comes directly from data published by WOW and analyzed against bank quarterly reports for the third quarter of 2024. That is roughly 80% of every single mortgage in this country sitting on 7 balance sheets. Now here is where it gets strange. According to that same analysis, 36.8% of those mortgages, which works out to about $596 billion, have a remaining amortization of more than 25 years. A 25-year amortization used to be the standard. It used to be the norm. Now it is the floor. 11.4% of mortgages have amortizations stretching beyond 35 years. That is $184 billion in debt that is going to take longer to pay off than most people will live in their homes. But the number that should genuinely stop you cold is this one. More than 4% of those mortgages are now classified as non-amortizing or negatively amortizing. That is over $65 billion in loans where the monthly payment does not even cover the interest being charged. The principal is not going down. It is going up. Every single month. The homeowner thinks they are paying their mortgage, and the bank's books quietly show the debt growing. Let that land for a second. How does a 70-year mortgage actually happen? It starts with a product that sounds perfectly reasonable. It is called a variable rate mortgage with fixed payments. You lock in a payment amount, say $1,500 a month, and when interest rates rise, instead of your payment going up, your amortization extends. The bank just keeps cashing that fixed check and quietly adds the unpaid interest onto the back of the loan. The Office of the Superintendent of Financial Institutions, Canada's top banking regulator, confirmed in their annual risk outlook for fiscal year 2024 to 2025 that these variable rate, fixed payment mortgages make up approximately 15% of all outstanding residential mortgages in Canada. That is not a niche product. That is a massive slice of the market. CBC News reported explicitly that 47-year amortizations already exist in Canada. They also reported that even longer ones are effectively emerging because the contractual term does not reset until the borrower refinances. You combine that with a loan in negative amortization territory, and you do not need to exaggerate to tell this story. The math just keeps running. The clock just keeps ticking. And somewhere out there is a homeowner who bought in 2020 at 1.9% who has no idea their mortgage is now scheduled to outlast their career, their children's education, and possibly their retirement. Now, the banks will tell you this has mostly been cleaned up. BMO, for example, disclosed in early 2025 reports covered by Canadian Mortgage Trends that at the peak of the rate hike cycle, 62% of its variable rate borrowers were in negative amortization. By the first quarter of 2025, they say that figure has shrunk to just 2% of their mortgage book, around $2.9 billion. That sounds like progress. And to be fair, it is. But that cleanup happened because rates started coming down and because the bank quietly restructured a massive number of loans. The problem was not solved. It was shuffled. And the shuffling has consequences, which brings us to the wall. If you have been following Canadian real estate news at all in the last year, you have heard the phrase renewal cliff. But most of the coverage undersells just how concentrated and how severe this event actually is. Here is the core data point. OSFI stated in their 2024 risk outlook that 76% of all outstanding mortgages in Canada as of early 2024 will come up for renewal by the end of 2026. A CMHC analysis, covered extensively in the Toronto Star and picked up by Canadian Mortgage Trends, puts the total number of mortgages hitting renewal in 2025 and 2026 at approximately 2 million households. 2 million households. Renewing mortgages that were mostly signed when the Bank of Canada's overnight rate was sitting near zero. Now renewing into a world where rates have been at historic highs relative to that era. TD Economics and CMHC together estimated that the extra cost to Canadian households from these renewals will amount to roughly $15 billion per year in additional mortgage payments. That is money that will not be spent at restaurants, on vacations, or in retail stores. That is money leaving household budgets and going directly to the banks. The payment shock math is ugly in any scenario you run. A report from Toronto Realty Blog, citing renewal data, estimates that mortgages renewing in 2025 will see payment increases averaging around 32%. For mortgages renewing in 2026, that average jumps to 48%. A YouTube analysis from the channel John AG, released in January 2026, walks through a clean example. A $500,000 mortgage taken out at 2% carries a monthly payment of roughly $1,848. That same mortgage renewing at 5% is now $2,953 a month. That is a 60% increase on a single line item in the family budget. For a household earning $100,000 gross, which works out to roughly $70,000 net after taxes depending on the province, that $2,953 monthly payment consumes about 50% of take-home pay. Before groceries, before property taxes, before utilities, before car payments. And that is assuming a relatively modest $500,000 mortgage. In Toronto and Vancouver, we are talking about a completely different world. Let me build out the income versus debt picture because this is where the story becomes not just financial but genuinely human. Data published by the Measure of a Plan and corroborated by Statistics Canada figures for 2024 puts the median pre-tax household income in Canada at approximately $92,740 to $93,220. The average home price nationwide sits at around $1.09 million. That gives you a price-to-income ratio of 11.8 times. A report from WOW on home affordability across Canadian metro areas, published in October of 2024, breaks this down further. In Toronto, the benchmark home price is around $1.1 million. The median household income is roughly $99,000. That is a price-to-income ratio of 10.7 times. In Vancouver, the benchmark sits at about $1.2 million against a median household income of $92,000. That ratio is 12.7 times. The traditional benchmark for affordable housing, used by the OECD and endorsed by virtually every central bank in the world, is a price-to-income ratio of 3 to 4 times. Canada is sitting at 3 to 4 times that threshold in its two largest cities. That is not a distortion. That is a structural break. Now let us run the mortgage math on $1 million home at 6% interest, which is not some worst-case scenario but a rate that has been very much in play for Canadian borrowers over the last 2 years. Assume a 20% down payment. That puts the mortgage at $800,000. On a 25-year amortization at 6%, the monthly payment comes out to approximately $5,150 per month. Take Canada's median household income of about $93,000 per year. That works out to roughly $7,750 a month gross. After federal and provincial tax, a family in Ontario nets somewhere between $5,200 and $5,600 a month. That means the mortgage payment on a median-priced home, in the country's most active markets, is consuming somewhere between 93 and 99% of the median household's net income, before a single other bill is paid. Better Dwelling, a Canadian housing analysis publication, reported that as far back as the first quarter of 2022, the median Canadian household already needed to spend 53.2% of their income just to carry a mortgage on a typical home. In Toronto at that time, that figure was 75.6%. That was at low rates, on homes that were slightly cheaper. Run it forward at 6% and the math simply stops working for most households. Not theoretically. Arithmetically. This is not a problem that more income will solve in the short term. Wages do not move fast enough. A Reddit thread in the Toronto Real Estate Forum, citing Statistics Canada longitudinal data, noted that Toronto incomes rose roughly 100% over the last 20 years while housing prices rose over 400%. The gap between what people earn and what housing costs is not closing. It is widening. And a wave of renewals is about to make both sides of that equation collide at once. Now let us talk about the regulator, because this part of the story does not get nearly enough attention. OSFI, the Office of the Superintendent of Financial Institutions, is the body responsible for making sure Canada's banks do not blow up. In their annual risk outlook for fiscal year 2024 to 2025, they laid out their concerns in language that was careful but unambiguous. They flagged real estate secured lending as a top risk for the year. They explicitly stated, and I am paraphrasing closely here because the exact text is available on their website, that they expect payment increases to lead to a higher incidence of residential mortgage loans falling into arrears or defaults. They noted that this payment shock would be most significant for homeowners who took out mortgages when rates were lower in 2020 to 2022. They noted that heavily leveraged households and those with variable rate, fixed payment mortgages will feel this shock most acutely. That is the regulator. That is the person whose job is to maintain public confidence in the banking system saying, on the record, in a published document, that they are expecting more defaults. And then, perhaps more telling than anything they said, look at what they did. On November 21, 2024, OSFI dropped the stress test requirement for straight, standalone uninsured mortgage switches at renewal. True North Mortgage and Canadian Mortgage Trends both covered this decision extensively. The stress test, which required borrowers to qualify at a rate 2 percentage points above their actual contract rate, had been the cornerstone of OSFI's effort to keep highly leveraged borrowers out of loans they could not actually afford. They removed it at the exact moment it would have mattered most. Think about why a regulator would do that. If you enforce the stress test during a massive renewal wave, you force millions of borrowers to requalify at rates they may not pass. They get refused by their existing lender. They cannot easily switch. They default or they are forced to sell. That creates a cascade of losses on bank balance sheets. It puts downward pressure on home prices. It turns a financial problem into a financial crisis. So instead, the regulator blinked. They gave the banks and the borrowers a pass. It buys time. But it does not fix the math. It just delays when the math catches up. OSFI is also, simultaneously, developing institution-specific loan-to-income limits and requiring banks to hold additional capital against their negatively amortizing mortgage portfolios. 4 banks specifically, BMO, CIBC, TD, and Royal Bank, were called out in reporting by Canadian Mortgage Trends in late 2023 as being impacted by new capital requirements tied to their negative amortization exposure. That capital requirement is a cost. It reduces what they can lend. It is the system trying to quietly build a firebreak without triggering a panic. And that tension, between maintaining confidence and actually dealing with a problem, is exactly the environment we are operating in right now. While the regulators are managing perceptions, the evidence on the ground is telling a different story. And there is no more concrete on-the-ground indicator of mortgage distress than power of sale listings. A power of sale is what happens when a homeowner stops making payments and the lender, rather than going through the full court process of foreclosure, uses a faster legal mechanism to take back the property and sell it. It is a bank-driven sale. It is a distress sale. And for most of real estate history in Ontario, you would not even notice them in the data because there were so few. Better Dwelling published research showing that in 2024, just under 1,200 new power of sale listings hit the Ontario market. That is more than double the number from 2023, which itself was already elevated. It is more than 5 times the 2022 level. A video analysis published by the YouTube channel Ron's Analysis in September 2025 put it in visual terms that are even harder to dismiss. In 2021, there were roughly a dozen power of sale listings across the entire Greater Toronto Area. By mid-2025, there were approximately 790. Nearly 3% of all active listings are now distressed, bank-driven sales. Another report from Better Dwelling published in August 2025 noted that power of sale listings in the GTA were growing 22% faster than total inventory year over year. When distressed listings grow faster than overall supply, that is a signal that the distress is accelerating, not stabilizing. The Toronto Star also posted reporting on Ontario's power of sale surge, noting that desperate homeowners were running out of runway after exhausting every option, including refinancing, borrowing from family, and deferring payments, before ending up in bank-force sales. And these are the visible distress signals. These are the loans that have already broken. The far larger question is how many of the 2 million renewals coming in 2025 and 2026 will produce the next wave of these listings. Let me give you the expert voices now, because this is where the picture either looks manageable or genuinely alarming depending on who you listen to and how carefully you read what they are actually saying. OSFI's published risk outlook for fiscal 2024 to 2025 states directly that the regulator expects payment increases to lead to a higher incidence of residential mortgage loans falling into arrears and defaults. It states that if labor markets were to weaken, the effects on credit quality could be material. The word material, in regulator language, is not casual. It means big enough to matter. It means big enough to require attention. You can read the full document at the OSFI website, and the link is in the description. CABC's Benjamin Tal has been one of the more prominent voices pushing back on the most alarming versions of this narrative. In reporting by Canadian Mortgage Trends from early 2025, Tal said that about 40% of mortgages renewing in 2025 will actually see lower monthly payments, not higher ones, because rates have come down enough from their peak that some borrowers are getting relief. He also acknowledged that a portion will see increases of less than 10%. His overall take was that the shock, while real, is more manageable than the worst-case scenarios suggest. That is a legitimate counterpoint. Rates did come down from their 2023 peak. Some borrowers will genuinely be better off at renewal. Tal is not wrong about that segment. But here is what is also true. Tal is talking about 2025 renewals. A significant portion of the most distressed loans, the ones taken out at the absolute lowest rates in 2020 and 2021, are on 5-year terms that renew in 2025 and 2026. Some of those borrowers locked in at rates below 2%. Even with Bank of Canada rate cuts, the rates available to them at renewal are not 2%. They are in the 4 to 5% range. For those households, the payment shock is very real and very large. An analysis from CIBC Economics itself, referenced in reporting by MPA Magazine in early 2025, acknowledged that while credit quality has remained resilient so far, mortgage renewal shock is still looming for 2026, and the concern is specifically around the cohort renewing in that year, when the 2021 vintage, the absolute lowest rate era, hits its 5-year mark. The Financial Consumer Agency of Canada's data on debt service ratios, combined with RateHub. CA reporting on how much of a typical Canadian salary goes to mortgage payments, paints a consistent picture. The average Canadian household is already close to the edge. They are not sitting on a comfortable cushion of disposable income that can absorb a 30 or 40% jump in their largest monthly bill. Here is the bigger picture, and this is the part that the financial media has not fully connected yet. The banks extended amortizations to avoid defaults. That worked as a short-term strategy because it allowed homeowners to keep making payments on loans that would otherwise have gone delinquent. But extending an amortization does not reduce the debt. It just pushes the reckoning forward. Now that reckoning is arriving in the form of renewals. And the question is not just whether individual households can absorb the shock. The question is what happens to consumer spending, to retail, to the broader economy, when 2 million households are forced to redirect a combined extra $15 billion per year toward their mortgage payments. That money comes from somewhere. It comes from restaurants that close. It comes from car purchases that do not happen. It comes from renovations that get postponed indefinitely. The knock-on effects to the Canadian economy of a consumer base that is this stretched are substantial, and they are not fully priced into the current outlook. Tiff Macklem and the Bank of Canada cut rates aggressively through late 2024 and into 2025 specifically to take pressure off the renewal wave. That is not speculation. The bank has said as much publicly. The rate cuts are at least partially a policy response to the mortgage crisis that everyone in the room knows is coming. But rate cuts take time to filter through. And the households renewing today are still renewing at rates that are dramatically higher than what they originally borrowed at. The regulator removed the stress test to prevent a cascade. The banks extended amortizations to avoid defaults. The central bank cut rates to ease the renewal shock. Every single major institution in the Canadian financial system has made a defensive move designed to keep this from becoming a visible, acute crisis. And they may succeed. The math might work out if rates keep falling and if the labor market holds. But there is zero margin for error in that scenario. If unemployment ticks up materially, if rates stall, if consumer confidence breaks and home prices fall further in Ontario and BC, which are already down significantly from their peaks, any one of those developments does not just stress the system. It breaks the model that is holding it together. The Canadian banking system is not in immediate danger of collapse. It is well capitalized by global standards, and the banks have been proactive about managing their exposure. But the households sitting inside those balance sheets, the 1.1 million people identified in reporting from a January 2026 analysis as facing the most acute version of this renewal cliff, do not have the capital buffers the banks have. They have a paycheck and a mortgage. And the gap between those two numbers is about to get very uncomfortable. This is not a story with a clean ending. The renewal wave is happening right now. The distress listings are rising. The amortizations are extended. The math on median income versus $1 million mortgage does not close. And the people running this system have made it very clear, through their own published documents and their own regulatory decisions, that they are managing perception as much as they are managing risk. What you can do, and this is practical, is understand your own position clearly. If you have a renewal coming in the next 12 to 18 months, you do not want to be surprised by the payment shock. The numbers are not going to improve dramatically by the time your term is up. If you are on a variable rate, fixed payment mortgage, ask your lender specifically what your current amortization is. Not the original amortization. The current one. The answer may be more uncomfortable than you expect. The data here is not alarmist for its own sake. It is the actual picture of where this country's housing finance system is right now, drawn from OSFI filings, CMHC reports, bank quarterly disclosures, and Statistics Canada income data. Every single piece of this story has a paper trail, and that paper trail is linked below. Thank you for watching this full breakdown. Every single statistic and report mentioned in this video is linked down in the description below so you can verify the numbers yourself. If you are dealing with this in your own life or if you completely disagree with my analysis, please let me know in the comments because I read them all. Make sure to subscribe for more deep dives into the economy and real estate market. I will see you in the next one.